On the topic of, has the Fed done enough? Have we not waited enough? Is it restrictive enough? Where is your head in all of this?
Well, big question. If you look hard, you can find some signs of slowing, right? You can see, for example, that some of the riskier borrowers are starting to confront higher interest rates. You're seeing downgrades, for example, start to increase to a level which we haven't seen for some time. You're seeing credit card defaults starting to pick up. And you're seeing, some slowdown in the pace of sales growth. So all this is good news for the Fed because it means that we're getting that kind of soft landing data that it's looking for. But if you look at, the single biggest way they have effect, it is through financial conditions. Financial conditions are back to the levels they were when the Fed started tightening. And remember, they were pretty easy then.
Right.
So the question that the Fed has to pay attention to, of course, last month's inflation data was comforting, but are they in restrictive mode? And part of the reason is the usual channels through which Fed policy works, higher interest rates, working through debt to slow down activity, or working through savings to slow down activity, don't seem to have effect. Household savings have fallen actually rather than increased, and you can see from the debt side, 30-year mortgages aren't being affected, of course, by these higher rates because people are staying on with their mortgage. They're not borrowing anew.
That's right.
And of course, companies during the pandemic pushed out the duration of their debt and so aren't recontracting debt at these higher interest rates. So the effects are long in coming, and the Fed at some point is going to start getting worried. Are we restrictive enough?
If not already.
Absolutely.
And you make a very good point. I think you started by saying if you look hard enough, you will see the rate-sensitive sectors listening. So in that case, that started to take effect. But it's really on the part of the inflation basket that doesn't seem to be listening to monetary policy. What does a central banker do in this scenario?
Exactly. And the key question really is which aspects of the inflation basket are still worrying. And of course, services are a big worry. The rental component is also a worry that has started showing some signs of decrease. But of course, rentals in real time are starting to push up again. So I think it all hinges around the labor market. With the household feeling comfortable about employment, with strong employment still, I think you aren't going to see a slowdown in consumption. And that's really necessary. I mean, everything sort of hangs together, but some labor market slack would be necessary to give the Fed enough confidence to start reducing interest rates. Until that happens, I think it's guesswork whether inflation will come down much further. They have to be in data watch mode rather than anticipatory mode.
Which was what Olivier Blanchard, who was, of course, on your panel just now, was here and said a few minutes ago, talked about how the labor market is still on the hotter side of things. So I guess let's make it simple. Do you think the next move from the Fed is a cut or a hike? A cut or an interest rate hike?
Well, I'm going to give the economist's answer. It depends it depends on the data.
Okay.
My sense is if they see some genuine movement downwards in inflation, if owner-occupied rent, if that starts coming down, which they've been waiting for a long time, if everything seems to be moving in the right direction for a few months, they may have the confidence at that point to cut. The last thing what they want to do is cut and then see inflation perk up once again. The real problem, of course, is by rates, they look restrictive. By financial conditions, they aren't. And which one do they believe?
And do you think, how do the, as a former monetary policy implementer, let's put it that way, how would you address that? I mean, do markets have to be part of the mandate in some way?
Unfortunately, I think the Fed wants to have it both ways. It's been, it has hiked rates reasonably fast to a high level, but it also wants to give the markets hope that rate cuts will come. I think it should stop talking about rate cuts and just say, we'll take what it takes. I mean, you hear that, but you hear also certainly at the beginning of the year, the cuts are coming. And that gives the market hope, which then makes financial conditions easier,
right,
which makes the Fed's task harder. So I would stop talking about rate cuts at this point and say, well, we'll do it when we do it.
Every meeting is live, and we'll see. I want to ask you about India. Elections results are coming out. In the event, and it's a tail risk, in the event we don't get a third term from Prime Minister Modi, do you think the infrastructure push is at risk?
I think there's a lot of continuity built into Indian policy. And so my sense is, whatever government comes in will take a lot of the good stuff that's been done and continue it. I think, of course, over time, they will have to, look at where they push. But certainly, I think, there's a budget due soon after the election. My sense is, for the most part, it will be a budget that pushes on all the good stuff that's happening while trying to see what other changes have to be made.
When you look at the numbers that the government is trying to push through in infrastructure, what they've built, what is coming online, and I think our colleagues at Bloomberg Economics have a number in the order of about $500 billion, if I'm not mistaken, US dollars of infrastructure that's coming on in the next 2 years alone. Is affordability an issue that you ever entertained, for example?
I think at some point you will have to look at the quality of the infrastructure that's been built. Not so much the physical quality, but do we really need one metro for every city? Or is it okay if we stop at the big cities and so on? So I think you will have to look at it to make sure you're not over-investing in infrastructure. But I think India's big deficiency so far was, in fact, infrastructure, which is being remedied by this push.
The critics would say the infrastructure push is geared towards benefiting the middle class and the rich, the sort of glitzy projects, and not so much the poor. Is that a view that you think that resonates with you? Or?
I think some of the elements of the infrastructure push will be taken up by big steel firms, for example.
Okay.
I don't think that is the primary intent. I think it is a genuine push in improving the quality of infrastructure. Of course, going forward, I think India does have to examine whether too much of economic activity is concentrated in too few firms. I think the answer to that is to level the playing field, to make sure many more firms have opportunities, both domestic and foreign.
Do you think the GDP number, and us in the media, of course, every quarter, this is something we obsess about, maybe, and sometimes over-obsess over. Do you think the growth trajectory we see on the headline level for a country this complex and this large, do you think that captures the economic story?
I think the 6.5% tag to GDP, which is what people expect over the next year or two, is quite reasonable. That's probably what India is growing at. I think the nature of that growth, a little too much towards capital-intensive growth, a little too little towards creating more jobs, that needs to be examined. But broadly, I think it also needs to be increased. 6.5 is too slow for a country with the kind of population dividend that India is experiencing, young people entering the labor force. We need to figure out how to get them jobs, productive jobs, so that India can not only employ them, but also up the rate of growth maybe to 8 or 9%, which is where we should be given that dividend.
Right, so suffice to say that's your view. 8 to 9% is what should be the potential growth of the economy that doesn't create inflation problems.
I don't think it will. I mean, look, where does inflation come from? From too constrained a supply. I think if you push for 8 and 9 today without enhancing the quality of the supply, you may run into inflationary problems. But I think a few small changes in improving the quality of the labor force, making people more employable, the kind of apprenticeships, the kinds of training programs that we're talking about, could actually increase supply to the point where it is not inflationary, and you can manage that kind of growth. Today, if you do it, you will run into labor shortage problems.
And you mentioned jobs as a sort of a weak spot, let's put it that way. What's the gap there? What do you think is not happening?
The gap is skills.
Okay.
Again and again you hear from firms, we have a lot of people, but are they skilled enough to work in my factory? And you're seeing where the jobs are coming, for example, in manufacturing, are in the southern and western states, where there are a lot of women available to work. They're skilled, and the work environment is such that they feel they can actually go to work. And so you are seeing a lot of success there. We have to make sure the rest of India has the same kind of success.
Right. And is it worrying to you that, let's say the percentage of jobs that you're seeing in agriculture, for example, is going up? Should that be going up given where India is in its development cycle?
Absolutely not. I think it is an indication that we're not creating enough good jobs in services and manufacturing. We're seeing jobs in construction go up. That's part of the infrastructure push. But we absolutely need to enhance the number of jobs outside of agriculture. Now, agriculture, temporarily may go up, but the sustained movement over the last 4 or 5 years, I think, is a source of worry.
Just very quickly here, on monetary policy, not so much in rates. There's a lot of inflows into India because of this bond inclusion that's taking place. There are conversations whether the RBI needs to include forex intervention as a direct tool. Do you think they should? Very quickly.
I think the RBI has always used forex intervention to reduce volatility, but not to establish a level for the exchange rate. I think it should continue doing that. I presume it will continue doing that. The level is established by so many other things.
All right.
But for the RBI to try and fix that level, I think is very dangerous, and it's never done that.